Rent vesting versus buying your own home to live in. If you're trying to find out whether buying your own place to live in or rent vesting is a better strategy for you, in today's video, we're going to go through a deep dive and work out the actual numbers. So stick around. Guys, if you're new to the channel, it's the first time you've come across our videos, or maybe you've been following along for a while, if you haven't already, make sure you hit that like and subscribe button, because here we talk about property investing and what strategies to go away. If you're not familiar with me, my name's Julian. I'm the head of strategy here at Ripehouse. And in today's video, we're going to be going into a bit of a deep dive in terms of rent vesting versus your own dream home. What are the pros and cons that we get into when we go down that pathway? And probably most importantly, what is the actual costs involved when we get into buying a place to live in versus renting? So I want to go into those numbers as a real thing. And I guess if you're not familiar with what rent vesting actually is, for those trying to follow along at home and not familiar with the terminology. So rent vesting is somebody who is renting in a location where they'd prefer to live, and that might be in a city, might be in outer regional, could be in another country, and they're living in locations where they'd prefer to live, but they're investing to make sure they're growing their wealth at the same time. So a good example of this might be people in, say, in the Gold Coast, Sydney CBD, or inner Sydney, inner Melbourne CBD, where trying to buy a property in those locations might be in $1 million plus territory, and they simply can't afford to buy in those locations. Or alternatively, they don't want to take on such a heavy burden of mortgage debt and having to manage that for a long period of time. And that's where we want to break down the numbers. And I guess understanding with rent vesting, it may not be for everybody. Rent vesting, there are some pros and cons in terms of, I guess, the benefit for a lot of people when they go out and buy their home. They've got that security, right? You're not concerned about whether your landlord's going to kick you out or sell the property from under you. And, if you've got partners, your relationship, kids, whatever it may be, you may want that need to have a place to call home. And a lot of people might like doing DIY, or that ability to just fix little issues or upgrade things around the home without having to ask for permission, which obviously on the rental side of things, you are forfeiting that flexibility. But we want to more so have a bit of a breakdown, the actual numbers regarding just purely, let's just say we've got somebody that don't actually care about if they're in their own home or if they're renting, and what does it actually look like from a rent vesting perspective. So at first, we're going to go through the dream home scenario right now. And even for most people, $1 million might not get them into a dream home, but we're going to look through some scenarios here. So we're going to look at number one, and we've got $1 million property. And the scenario we're using here, most first home buyers, they're going out there and they're taking advantage of the 5% first home buyer scheme. So they go out, buy their $1 million property. They're at a 95% LVR. So they're essentially taking on a $950,000 loan. And again, for simplicity, for the comment police out there, we're keeping things really, really simple for today. We're taking on a 95% loan. We're not going to go into stamp duty and all those fees. You might get concessions. It varies from state to state, etc. And we're going to base this off. We've got a 6.5% interest rate. So if we've got a 6.5% interest rate on our $1 million property with a $950,000 loan, that means per week, we are paying $1,187.50 just in interest. Now, if you've got your home, you're probably going to be on principal and interest. So you've got your principal repayments that you also need to be paying down. Most people are going to be doing that over a 30-year period. So your $950,000 mortgage broken down over that 30-year period over a weekly cost is $608 per week. And then you've got your outgoings. So your outgoings are your things like rates, water rates, insurances, just general maintenance around the property. So that's going to vary. You're normally going to see, particularly in a $1 million property, you're probably going to be around that kind of $7,000 to $8,000 per annum territory. So in this instance, we've rounded up, it's going to cost us $150 per week. So per week in total, if we run through everything, this property to hold is just under $2,000 per week. And one thing here we've highlighted, this is post-tax. So one of the big differences when you've got a property to live in versus an investment property, this is post-tax money. So what do I mean by that? So if I'm somebody who's got $100,000 as my gross income, the tax man's probably going to give me, take around about $20,000, give or take, post, I'm left with $80,000, which means I'm paying this money after the tax man has already taxed me, because the interest, the principal, the outgoings, none of that can I claim as a loss when it comes to tax time. So I'm going to be severely impacted here. So from a cash flow perspective, I need to have close to $2,000 per week to be able to manage this property. Now, if you've got the ability to do that and you have that desire to take on that larger loan, then this might be fit for you. Now, some of the pros are going to be, you've got your forever home, you can set yourself up. You're not, like I mentioned earlier, you're not worried about being kicked out or whatever it may be. But as you can see here, it is quite cash flow heavy from a servicing standpoint. And this is going to impact you longer term in terms of, if you're going out to the bank and you then decide, I want to go get another loan, well, when they're running their serviceability on you, they are going to turn around and go, well, that's great, person A or Mr. Smith, Mrs. Smith, but we already know you need $2,000 per week in terms of cash flow just to keep this property going. And then if you've got kids or you've got car loans or jet skis or credit cards, whatever it may be, again, all of those things are going to be adding on to your cash flow expenditure, which will make your servicing smaller and smaller and smaller. So you're going to be tied to this cash flow predicament for a long period of time. And for a lot of people, particularly now, it's getting more and more popular. It's not a new trend, rent vesting, but a lot of people don't want to have that continued stress or debt sitting over them. They want that flexibility to be able to move, travel, go on holidays, shopping, going out to restaurants, whatever it may be. So they want another option. And I guess the other option is, what we call rent vesting, where we want to be able to continue to grow our wealth. We're not going to get lazy. We're not just going to go rent and then not continue to grow our money by investing, but what that rent vesting looks like. So we're going to run through another scenario now. I'm going to pull open my spreadsheet and let's have a bit of a deep dive into what that actually looks like from an investment perspective. Alrighty. So if we go into this scenario here now, admittedly, again, to the client police, I want to make sure we just speak really, really up in front. What I'm looking to do in this scenario is just present some opportunities in terms of, we're looking at the cash flow. Okay. So admittedly, in these scenarios here, we're going to need more starting funds to make this purchase happen, because for this scenario, I'm using a 90% LVR, because most people investing in property are going to be somewhere around that kind of 80 to 90% LVR. Some professions, they might go as high as 95. Some people might go 100% if they've got assets to do that with. But firstly, we're going to look at a $1.5 million property. Now, for the numbers as we go through this, I've spliced this up to be, $300,000-$500,000 properties. So for this example here, again, just trying to show from a cash flow perspective what that looks like. So we might have 3 properties at $500,000. We've got $1.5 million of asset value associated to us at this point. And we've got all our outgoing fees associated here. So we can see here, we've got potentially some depreciation benefits across that portfolio. We've got our council rates, water, insurance, maintenance fees. And we've got our 2 numbers we want to look at here. So we've got our annual before tax. So holding these 3 properties are costing us $643 a week. And then we've got our weekly after tax. So if we're around that kind of 30% tax rate, it's costing us about $326 per week to maintain this portfolio that we've got at the moment. Now, the thing that I just want to have a bit of a breakdown here, we still need to factor in our rent, because if we're not having a place to live, we've still got to be able to go out there and rent somewhere. So in this example here, I've got us renting somewhere. And on the interest-only segment, we can see here our cash flow is significantly lower on the requirement side. So we're renting a property, it's costing us $750 a week, and we've still got our weekly after-tax number. So we combine them, we're $1,076. So we've essentially created nearly a $900 a week difference in terms of our cash flow. And the other big benefit here is we're actually invested in a property that's worth $1.5 million. So we've got a 50% larger asset pool that is growing for us. And if we just run with average numbers, if we've got the $1 million property that we're living in, or the $1.5 million of investing, we've got $1.5 million. So if they're growing at the same rate, the bigger pie to start with, we're going to get further ahead. Now, the argument can be made that in the first scenario, we were running off principal and interest. So why don't we do a fair side-by-side comparison and see what that looks like? So even on this portfolio, we're paying that down across the way. So we pan across now to the principal and interest version of the same scenario. So we've got the 3 properties at $1.5 million. Again, we've got very similar outgoing costs along them. We can see before tax it's costing us $1,500 per week. The principal portion is non-deductible, so we can't put that in the after-tax concessions, but we can come down here, and if we factor in with our rent repayments, we're still below the outgoings where we had the $1 million property and we were paying the mortgage down. But in this scenario, we've got $1.5 million worth of property and we've got a place to live in, and our cash flow is actually a little bit less. So we've got that flexibility to be able to scale that down. Now, we could argue we're only going to get into a $1 million worth of property. So again, we're going to be able to chop and change our cash flow. Some of the other benefits, if we go back to scenario 1, where if we're on principal and interest, the fantastic thing that we have is flexibility. I think that's what a lot of people like about rent vesting, where if you've got a 30-year mortgage, you need to keep working along to keep servicing that property, particularly because the principal portion is there. So you need to keep working away to keep that afloat. Yes, you can rent your property out and you'll get some income coming through, but it's still, you need to keep servicing that property. The great thing about rent vesting is if you decide to go work abroad, go on travel, you get to turn this tap off on the rent side of things. So all of a sudden, you're only $326 per week out of pocket, and you've got that flexibility to keep scaling back. And as time goes on, you might see interest rates come down a little bit. You'll see your rental increases go up. And these properties can start to wash their own face, where they're costing you very little out of pocket, but still growing your wealth for you over time. Where if we have a look in this scenario here, where, maybe we see interest rates come down to 6%, maybe we see a couple of rent increases. If we say over a 2-year period, these properties maybe come up around, a few, maybe $50, $60 extra per week. We start to see these properties are only really costing us about $100 per week to hold on to, whilst they're still growing for us in the background. Now, for a lot of people, that freedom and flexibility is a very, very attractive model, and rent vesting could be a short-term solution for you. So what I mean by that is you may decide that, you're young in life, you're in your 20s or you're just touching your early 30s, and you're not ready to have a family for 3, 5, 7, 10 years. So you might decide rent vesting is a thing for you, and you've invested in these 3 properties or 2 properties, however it's sliced up. And once these properties have appreciated in value, you may decide that it's time for you to get your forever home now. So you sell your properties off for profit, you pay your selling costs and your capital gains tax, and then you go out and you take on a property with a much lower mortgage. And, you don't have to have that non-deductible debt afterwards sitting over your head. So that's where the big benefit is, well, because the other thing to consider is that before tax number, all of this outgoings on the investment side is pre-tax. So if you've got your $100,000, these losses are coming off that $100,000, and then you're getting tax on what's left over from there. So I hope that makes sense. If you've got some questions on this, feel free to leave a comment in the box below. I'd love to know your thoughts on it. And if you'd like to know more about investing strategies, or if you're thinking about property investing, you're just not sure, feel free to click the link below to have a conversation with me. More than happy to pick that conversation up. But if you haven't already, like I mentioned earlier, smash that like button, make sure you subscribe, and I'll catch you all on the next one. Bye for now.